Hello, ladies and gentlemen. Welcome to IBM Financial Show. My name is Sasha Star, and I would like to introduce my esteemed longtime co-host, Peter Bennett. He worked on Wall Street in finance and has a law degree and MBA from New York University. Peter, how are you today?
Hey, Sasha. Everything's good. How's everything with you?
So what do you think about markets these days? It's a little bit frosty now. It seems to me that it's on the verge of either going much higher in the next few weeks or could be much lower at the same time too.
Well, that's always the issue, right? But, yesterday the NASDAQ hit an all-time high. And
Yeah.
the S&P is very close to an all-time high. And
Mhm.
you know what? I've been saying it all year. I said at the beginning of the year when I just came on the show that I thought the market was going to go higher because my theory is everybody looks at it short term. In other words, you look at it's always greed versus fear, basically. And the
Absolutely.
fears out there are, seem real, and they are to a point, some of them. There's fear of Delta, but that's going to go away. Eventually they say in the US, 75% of people have been vaccinated now, and a lot more people have had it. Eventually, everybody's going to either have it or be vaccinated. And, we may need boosters, but that's not going to change reality too much. And around the world, more and more people are getting vaccinated. And people are just going to adjust anyway. I heard a quote that said, people eventually are just going to get tired of it and just start living their life again, because people aren't going to go 20 years hiding in a mask in their in their living room. So then there's fear of inflation, and inflation has been high. As a matter of fact, the recent indicators were 5 to 6%, but it's overdone because first of all you have wage inflation, and all of a sudden you have the unemployment benefits, which were excessive, expiring now. So millions of people are going to say, hey, it's time to go back to work. I just had a 9-month vacation or whatever, and I've been getting paid much more to sit at home, but now I need to get a job. So I think, and the recent report was very disappointing in terms of employment, but that's because we're just at the edge. Now let's see what happens when people have to work again because their unemployment goes down. So those fears I don't believe. And Biden and the Democrats are a little dangerous, and that is a real fear, and that's there, but it doesn't affect my long-term outlet. But here's an interesting piece I got out of Barron's. It says, don't expect stocks to shrug off a tax increase. Bank of America strategist Quan estimates that a 25% corporate rate, and they're talking about at least 25, would cut 22 earnings estimates by 5%, raising all of next year's profit growth. And he also pointed out that the tech sector and healthcare would have a 7% decline in earnings. So those two are really exposed to a point. And they said oil, real estate, and utilities would be basically unscathed. So, and there's a few points there. One, I'm not worried about my tech companies because they're so undervalued anyway. They'll just, even if they had a year of no growth, they'll just keep growing. But so that's a real fear, but, in terms of the short term, but then you go to long term where I think interest rates are going to zero, as we know, based on the 40-year decline and based on demographics, which are all so strong. Aging populations don't invest in the market. Older people spend their money down. People are going to underestimate what they need to live, and they're going to take their money out of the market, and they're also going to be very fearful. And also you have debt. The debt around the world with all countries is astronomical. Countries are not going to want to pay interest rates. And then you have technology, and that was my next point. This is my favorite, picture of all time, which I'll then tell you what the point is though here. But this is a robot built by uh,
Mhm.
the Oregon State University. I don't even think it's the top university, but I mean it's a good university. But they built this robot for $1 million, and it runs 5Ks in 53 minutes. It's a very sophisticated thing. But these are kids. These are students, maybe good students, but I mean, so my point, and these are the kind of things I see every week. Tech threatening to take jobs. That's why I'm not worried about wage inflation, because now we've been watching the U.S. Open, my wife and I, and
I
guess
do too. I
what?
do.
And you know what? All of a sudden, all the lines are being called by machines. You have,
Yeah,
you have a
yeah,
you have,
fantastic.
yeah, and
Nice.
you have a different voice. I mean, it's not major, but I think it's cute. So they have a different voice for the back line and the sidelines and the serve lines. And once in a while, a player wants to see it again, but they never make a mistake. So
No,
now these
no.
machines are just an example of why 30-40% of jobs in the next 10 years are threatened, seriously threatened. Whether it's the point I keep bringing up, but I just love this idea of the Fort Lauderdale restaurant that has 3 robots, that
Mhm.
one greets you, one takes your order, and one brings you your food. These are the kind of changes that people are underestimating. So I just look 5 years down the road, 10 years down the road, and say, I'm not worried about wage inflation. Housing will keep going up because interest rates will keep going down. That's where you'll get inflation. But other than that, I'm not worried about it.
Yeah, Peter, I agree with you. And of course, you're right about this unemployment benefits will expire, or are actually
Yeah.
it's already expired. So people will sustain themselves for a while. They will sell their Cadillacs and all other luxury items that they could they were able to buy recently, and then they will still have to go and join the workforce. That's
Yeah.
absolutely unavoidable, and which is good for economy because I've heard the survey. I think in the morning today on CNBC that half of employers on a survey, they were saying their biggest problem is to find people
Workers.
to employ workers. They
Right.
have big problems just to find workers. So maybe this situation will improve maybe in next few
Yeah, it
months.
is a good job market right now, and
Hmm.
I think there'll be some wage inflation for a little while, and I mean, it'll work its way through though. And again, adding all these employees to the workforce, but again, I don't invest generally. I do some trading, but I don't invest for a year or two. I look 5 years, 10 years. The more wage inflation goes up, the more robots are going to be more cost efficient, and the more robots are going to take jobs quicker. So in the end, it winds up the same place. I mean, not 9% of people in the U.S. and a large percentage of people around the world make their money just driving people, and the EVs are coming, and they're going to have driverless cars, and so they're going to pick you up in a limo, and you're not going to have a driver there, and those jobs will be gone. But that's just an example. Everywhere you look, there are jobs where you know they're threatened basically, and not all jobs, but people adjust and new jobs will be created. So it won't be a total disaster, but it's gonna reverse. In other words, it's not going to be endless. We can't get employees because we'll get robots.
Peter, you know how many cases were there with actually high-paying jobs? uh, they were giving notice to their employer that unless they will get 50% increase, they're quitting. Okay, there are many cases like that. So we definitely need more workers who are available, skillful, of
Oh
course,
yeah.
for those jobs. Now the beauty about robots is that they don't ask for increases. Okay, they don't have any benefits, unemployment insurances, and medical care, and so
Yeah,
on.
they show up on time. There's
Always on time. Yeah.
unfortunately, and everybody underestimates. I mean, these robots, from chess, because you have your chess show. I mean, there was a long time when people could beat robots, but then And chess is a very complicated game, as most people
It
know.
is.
I mean, extremely complicated. There's endless variations almost. And yet, eventually, IBM Watson beat everybody. And now you're not, they worry about it in the tournaments, whether somebody's cheating by going to a machine because the machines are better than people. Well, if a machine can play chess, it can do a lot of jobs that people can't.
Absolutely.
So again, I look 5 years down the road, demographics, debt, technology. Technology also forces less inflation because people can price shop so easily now. So you can't raise your prices too much. It puts pressure on the retailers. So that's I'm not worried about it, and that's why the market is climbing a wall of worry.
Yep.
And you know what? But it's been acting all year like I expect in the long run, which is basically interest rates to go down. Because if interest rates are going down, the S&P and the Nasdaq are doing exactly what they should be doing, gradually going up. Because that's what they've been doing perfectly. Because that's
I
where you
see
want to
right
be.
now.
You want to be and invest in dividend stocks and growth stocks, in any
Absolutely.
stocks maybe, because you don't want to be in. You don't want your bonds in 5 years or 10 years to roll over and get 0.02%. And in many countries already they're paying zero.
Peter, but still, we both agree that there are signs of inflation anyway, from housing,
Yeah.
the gasoline prices, many others. And because of the gasoline prices, the food prices are climbing up slowly and so on. So now a lot of people are worried on the market about upcoming Fed meeting on, I think, September 21st,
That's
22nd.
funny. Yeah.
What they're going to do, have no idea. They're going to raise interest rates? Probably not. But just to,
This is a perfect example of what I'm saying. Everybody's worried. Will the Fed raise interest rates an eighth of a point or a quarter point in 22 or 23? Will it raise it,
oh, yeah,
1/2% in 28? I'm joking about that, but I'm just saying they're all worried about a quarter and eighth interest rates. First of all, the Fed cannot raise the interest rates a lot because we're in the United States and the world is now addicted to low rates. So
yes,
if you
absolutely.
raise rates a whole lot, the mortgage market will collapse. Finance companies will collapse. Well, no, finance companies actually will do pretty well, but the mortgage markets will collapse, and a lot of companies that are depending on low debt will collapse. It can't happen because you have more and more service jobs. Look, if the rates were to go up, then all of a sudden mortgages go up, and then now all of a sudden your realtors are having trouble making money. Your construction people are having trouble getting money. So it could go up, but it's also relative because if you have this is my theory that I've never heard, but I'm sure somebody's said it. But my theory was if you have a 10% mortgage rate, you can a 5% increase to 15% is 50%. Well, if you have a 3%, if you have a 2% interest rate, a
Yeah,
1% is the same effect. So it's a relative effect. So they since rates, let's say on the mortgages, I'm just picking a number, I don't know what it is today, but let's say it's 4. If rates go from 3.5 or 4 to 5 or 6, it's going to be a phenomenal effect on the housing market, on realtors, and because it's all relative, because those high-priced homes are based on low interest rates,
absolutely.
and so it's not going to happen. Now, here's an interesting thing too in the markets. Very interesting. My big play is always, I love tech, but the number one thing is oil and gas, especially gas-oriented companies. I love TRP, 7% of my portfolio, but this week I really went for it with MPLX. I'll get into it later, but I love MPLX, but I love the midstream. So last week, the best midstream had one of its best performances of the year, and oil and gas was up 7.4% just last week, the sector.
Beautiful.
Also, I just read today, right before the show, you ready for this? U.S. oil demand just hit a record high. Now,
Right.
that is in spite of COVID, in spite of, whatever fears of unemployment or whatever else fears there are. And also, it's still with jet travel being somewhat limited, especially international, although that's going to pick up. I still like Delta, options. I sold 75 options. I love Delta too, because in
Yeah.
the long run, it will recover. But So I did that for 23, but sold 23 options at 75. But the
You sold
US,
puts, right?
yeah, I sold puts exactly
Exactly. Very
at
good. Very good move.
75. Basically, if it
It's quite
doesn't
quite
if it doesn't
aggressive.
hit 75 in 2 years, I'll just roll them until it does, because it used to be
Absolutely.
much higher, and it's going to recover because they're a profit. They're cash flow positive already. They're making a small profit now, and the business market's going to come back. So, and everything will come back eventually. So, but here's the thing, and I've noticed this already. Every time I go out on the roads, I tell my wife, "Look how busy the roads in Connecticut are. It's incredible." And everywhere we go, everybody's driving. There's traffic when there didn't even used to be traffic. And besides that, I like natural gas anyway. And so these people think, oh, we're just going to replace everything, 1, 2, 3. It's not going to happen. So if you have a high dividend MLP like MPLX or USAC, which are the two favorites, or TRP, which is just going to keep increasing its dividend, then you're going to get your money back way before they can replace oil and gas. And a lot of the forecasts say you're not even going to the natural gas will be hot, demand will be higher in 20 and 30 years than it is now, which it probably will.
I totally agree. And the roads in Toronto area where I live is also getting very, very busy, traffic and
Yeah,
so on. However, let's take a little break here and we will continue right after the break.
very good.
Thank you, Peter. Now, I would like to touch something of a phenomena which includes high tech, finance, world of visionaries. I'm talking about cryptocurrencies, bitcoins. What happened, in your opinion, yesterday? And today, actually, is a continuation of the move. It went down, what, 8%
No, actually, we were talking about it before the show. It went down 17% in a few minutes today,
how
which
that
is,
happened?
well, it was a flash crash. It's
Oh,
basically a trading phenomena. But here's the thing, I always say my favorite quote of all was John Paulson, the hedge fund, who said, Bitcoin is a limited supply of nothing. And, I would say it could go to $1 million, it could go to zero, but like tulips in Holland, it's probably going to zero. So, but here's the 2 points. One, the very fact that it could be so volatile. Yesterday it was at 52. Before the show, I just looked at it, it was at 46 and change.
yeah.
In 1 minute, because this is how something without fundamentals behaves, because nobody can really truly value something without any fundamentals. But here's the other interesting point I picked up this week. So the big argument for Bitcoin specifically is it's a limited supply. They're only going to print, create a little bit more, or it's done. So it's like gold. You can't create anymore. But here's the thing. Dogecoin is another cryptocurrency. And by the way,
Yes.
there are roughly 7,000 cryptocurrencies now, which get
Yes.
created. They keep getting created. But so I read Dogecoin is up 6,000% since its creation, and it's outperformed Bitcoin. But here's the difference: Dogecoins, they've already created 21 million of them, and there's no limited supply because they're saying we'll create more. That's why they only trade for a few cents, each. While Bitcoin's like 50,000, this one's a few cents, but they've created 21 million and they're going to create more. But so why is it worth anything if there's no limited supply of Dogecoin, not to mention other cryptos? But that's just another argument for how flimsy the fundamentals are, because people are loving Dogecoin, but Dogecoin has no limits. So, yeah,
Peter, do you think it's emotional attachment to something, but people don't understand, but they're just emotionally attached. What's the phenomena here?
Well, it's everything. I mean, it's, why do people invest in anything? I mean, whether, look, I'm not saying it's definitely like Madoff, but why do people, it's greed and fear, basically. So, right now it's partly greed. Oh, I could put $1 into, crypto and it'll go to 50,000 maybe. And a lot of people made a lot of money and people are trading it too. It's also a very good trading vehicle, I've heard. So, people who just want to trade might value it for that and just say, okay, I'm going to get in to trade it. But these things, I just don't like. In the end, it's the fundamentals. And, I mean, I like gold and silver much more because at least I know there's fundamentals there. Silver.
It's a historical value. I mean, we're talking about thousands of years of building.
Well, yeah. Well, with gold, it's not they're not creating anymore. And with silver, there's going to be huge demand. So I have 3% in gold and 2% in silver through options, long-term options. I sold at 54. But with silver, they're going to be needed EVs. And I fear that there will be a huge precious metals shortage in our lifetime. And I wouldn't be surprised. It's not, and people don't recognize it yet as much, but I think that, there's only so much in the planet of these precious metals. So, and silver certainly, should hold up decently.
Peter, I have a question to you. Okay, we more or less understand how market is being created for stocks like Microsoft, for example. There are market makers. Let's see, for example, Goldman Sachs. They have
Right.
market maker who is making market for Microsoft. Now, the way it's done, correct me if I'm wrong, it's, let's say, market maker, he gets up in the morning, and he has a supply of, say, 50,000 shares of Microsoft and almost unlimited supply of cash. So he's trading Microsoft stock, depends on supply and demand factors and market conditions and so on. However, he must finish the day with the same 50,000 shares of Microsoft. His cash position, of course, will be different, depends on his success or failure in some cases to maintain the market, but that's how it's done. So how the market is being made on Bitcoin, for example? Is there a market maker who's like?
No, I don't think so. I have no, you know what? I don't know. I haven't studied them. I don't think so because, but they're probably, look, there are traders out there who maybe they want to keep the same position, but you're right. Except for the fact that there are a lot of the market makers are now machines. But you're right, in the end, the market maker, does trade that way to a good extent. And but with Bitcoin, I don't know. I mean, look, the whole thing is, how did tulips in Holland trade up to $200 a tulip? I don't know. The roaring 20s, things went crazy in the stock market.
Yes.
And there was another one too, where an English rush. I don't remember all the details now, but a long time ago, all of a sudden, people started throwing money at things, and none of these ended well, because if too many people jump into something without fundamentals, sooner or later it's going to go the other way, and then fear is going to take over.
The problem is when you're a driver and hairdresser or talking about Bitcoin, that's kind of a worrisome sign for sure. But Peter, again, to explain this phenomenon of last 2 days with Bitcoin, there must be a huge selling at the same time, and it's not individual investors. They don't have so speedy access to information and so on. So it must be institutional traders, investors, and whatever.
Well, you're right. Probably. I know they are. A lot of the institutions like it too, because again, it's a great trading vehicle. But again, there's no fundamentals. It's like, okay, look, I always hold this pen up. I say, look, we could all trade this pen, and this pen could go to 50,000, and it could be the best trading vehicle of all. Maybe it'll go up to 50, 60, 40. People like the volatility of it because it's quick volatility, so you can make money, but you can lose money. In the end, if it's a trading vehicle, for every dollar that somebody's making, somebody's losing $1. And so it's a trading vehicle unless it goes up much higher. But again, in the long run,
you just said very important thing, a trading vehicle. It reminds me of my favorite story. Remember when two men in New York, they meet And they're talking, how are you and everything. And another one says that I have great news. I've got a container of sardines, cans of sardines, and they cost only 15 cents a can. So the other guy thinking and asked, oh, can I buy it? I'll pay you 17 cents. So the guy thought, okay, sure, it's good profit. Yeah, he sold. So next day he started to regret that he bought at 17, and the other guy regrets that he sold at 17 when it's probably worth 20 and much more. So he's buying back at 17 cents, and now next 2 days later he sold him at 20 cents now. So when price went up to 25 cents, one guy said, you know, I opened yesterday a can of sardines. They're horrible. I couldn't even eat them. So the first one says, it's for trading, not for eating.
Yeah, exactly. Yeah, exactly. So, so we better get to options, and because moving along, and we're keeping the new show to 30 to 40 minutes. You know, so.
And remember last week you promised to tell us about.
Oh, I've got a good one. I've got a good one. So,
okay.
The company is KLA Corp. It's KLAC is the abbreviation. And they make, ready for this, the equipment that's used to make chips. So they're the equipment maker who help make chips and wafers and circuits and things like that. So we know the chip market has been huge demand. And also, to me, chips are going to be, we're in the information age, and they're going to keep advancing the need for chips. I mean, eventually, I think we might have rooms like the holodeck, on Star Trek, where people can like be in a reality. I wouldn't be surprised at all. It could be done today, really. So
what's a symbol again?
It'll use KLAC. So this one I got out of Barron's. It was a mutual fund manager and was one of the stocks he talked about a little bit. But he made the point. He said, when people were in the gold rush, a lot of people went out to make a fortune, and very few people actually made money on the gold rush. They all, a lot of people, thousands of people, maybe tens of thousands. I don't know how many, maybe 50,000, 100,000. I don't know, but tons of people went out there. They went to San Francisco and they went to Alaska. Well, but the people who made the money were not the people, generally, were not the people who went to the gold. It was the people who supplied them. And particularly, he pointed out, who made the most money on that gold rush? Levi Strauss. Because everybody wore the jeans, because they were solid jeans.
And don't forget about saloon owners.
Oh, yeah. But I'm saying the big winner, because they sold so many Levi's to everybody. But I'm saying, so this is the company that's supplying all these chip makers like NVIDIA, which we love anyway, and, all of them, which we know the demand's huge. They can't keep up. It's going to be bigger. It's going to keep on growing with information technology. So this company is making the equipment. So they're the Levi's of the chips. So
it's one of the favorites of Jim Cramer.
Oh, that I didn't know. I didn't know that.
And I know this company for a long time. Actually, I was trading options on this company at least 10 years ago.
Oh, okay. Well, it probably went up a lot since then. I know that, but Jim Cramer, I have some doubts about. But I think he's very knowledgeable. He's an amazing person, but he picks everything. You can't be an expert in everything and say just off the cuff, oh, this is a great company. So I don't know if the depth is there, and we get into that more. But
but this is fundamentally, it's a great idea.
But here's about KLAC. So. First of all, the interesting thing is it's not just an options play. You could play it as almost a dividend play. It's got a 1.25% dividend. And if you look at TD Ameritrade, these are the growth for the annualized for 5 years, last 5 years. It's been increasing its dividend 12% a year for 5 years.
Good.
So annualized. So, you say, okay, well, that's not a bad dividend play, although I'm playing with options. But because I like certain other dividend plays even more, but but you say 12% a year in 5 years, 6 years, it doubles and it keeps doubling, and it's a nice, decent income. But also, its revenue has been growing 18% a year annualized for 5 years. That's per year. It's and it's that its revenue is 18%. Its EPS, earnings per share, 21% annualized. And what I liked about it too is the stock is around 335, but
Right.
the analysts say just 1 year target. It's when you say target, it's complicated because some people 6 months, a year. Nobody will peg themselves, down to a time. But the target's 384. So I said, okay. So I sold 2023 400 puts, and I covered with 250 puts, and I got a nice, premium for the fact that of the time, the 2 years. So I wouldn't be surprised if it hits 400 by 2023, but if not, it's a roll anyway. I get to keep the money, but and it's very, again, I don't see it going down under almost any scenario because this is a company that's just going to grow and grow. So
Yeah.
that's a great pick. To me, I like the concept too. The equipment, the Levi's.
It's a perfect business model. I mean, because everybody, especially now, there's a shortage of chips. I mean, there will be need for equipment and updates equipment and so on. Yeah, no, it's a great idea. Now, I still personally. I started, on one of my strategies is selling covered calls. And when they're expiring, I'm selling next one. Normally, I sell a little bit higher than the stock price, so slightly over the money. But now I'm a little bit more cautious, and I'm selling in the money calls.
Oh,
Yeah, in the money, because of course I get much bigger premium, and also that creates additional protection in case of I don't expect a really big downside in the market, but let's say 5, even 10% is possible.
it could easily happen. The market's so valued high. I mean, again, it depends what time frame you look at. And if you look at the short run, it seems a little like it's really run up a lot. But again, I look at the long run, so I don't care. Because
Yeah,
if it takes a dip, I mean, everything I'm buying either as long-term option plays or long-term dividend plays. So I'm holding on,
yeah.
which leads me to MPLX, the dividend play, because Tom's running again. And so MPLX, I learned another fact. I mean, I have like 20 things I like about MPLX. I love MPLX, and I love the midstream partners. But besides the fact that it's paying almost a 10% dividend, besides the fact that I think it's more like a utility because it's about 75% natural gas, 25% oil. This demand for this is going to continue. So you get your money back either way. MLPs have certain tax advantages and certain disadvantages. We'd have to do a separate show on that. But and we talked about maybe doing one. But it's easily covering the dividend. It's got about a 7 price over cash flow. So in other words, it's earning about 13 or 14%, maybe 14% cash flow. So it's got enough money to easily pay the dividend, and it's been buying back shares. It could use the money for pay down debt. And that doesn't even count all the projects they have in the works already that are going to be completed in the next few years. They're major projects. When they come online, they've already put that money in. So now it's like, boom, another spigot turns on to create cash flow. And that's not even built in the cash flow. So I went huge. I can't even figure it out because I am all over the place. I have shares, but I protected some of the shares with, and then I had some high options I sold too. But overall, I've never had a bigger position in terms of dollars and percent because I'm probably arguably 15 to 20% in one company. And I protected some of it with options, as I said, in different ways. But a lot of it is just straight shares. But so this is the added fact that just another thing that just pushed me over. If you look at the short interest in this company, it's over 5%. And that's insane because how long can these shorts be short this company when, and maybe it's about 5.5%, but they're going to have to pay the dividend, first of all, every dividend that comes due. So they've been playing games, and I've seen this plenty of times with MLPs. What they do is try to create scares. So they short it and they try to get people to sell, and then they cover. And I've seen this game in the MLP market over and over again. It works really well sometimes. I saw it with a lot of MLBs. But first of all, I don't even know if they could pull it off this time, because I think more and more people are saying, why would I ever sell these stocks? It was around 29 today, and it's been going up and up. So the short sellers lose power. Because let's say you bought a stock at 25 and it goes to 29 and they push it down to 27, it doesn't scare you as much. If you bought at 25 and it goes down to 20, it's like, oh, no, I'm going to lose all my money. So they've lost some leverage there, but also they don't want to pay these dividends. And who knows, next quarter, maybe they've announced a lot of dividend increases over the years. Maybe next quarter they increase the dividend again, and then nobody will sell. So there's so much pressure to me on the short sellers. And I don't know why anybody would be 5% short.
This situation when there are short sellers and the stock paying almost 10% dividends, there must be professionals, because ordinary people don't even know much about this stock. So there must be professionals. And
you're right. And you know what they could be doing? They could be maybe they have options positions, so the shorts are maybe they're going to make money on that. But whatever it is, that's just another reason to me. But it may not. It may be that you're right. It's probably a lot of professionals, because nobody would be short. And maybe it is options where they figure that we'll make money on the options anyway. So even if we lose on the short positions, but I don't see that as a long-term strategy on a company that I think is worth. I don't know. Maybe my target would be like 36 today. I mean, and it's at 29, as I said. So I'll just keep collecting the dividends, and and my plan is to hold it for life. Look, at 10% dividend, I get my money back in 10 years with the tax advantage. And except for I didn't even I bought it in much less. I mean, I bought some at 23, some at lower. But even today, if I get 10, I don't think the oil and gas industry is going to change that much in 10 years, that it's going to reduce their cash flow from, what they're earning now 14% down to below 10. And even if it did, I got almost all my money. So it seems like almost a risk-free play to me. But because I'm a huge percentage, I did cover a little bit at lower options, really low options, just in case like a meteor hits, the planet or something, because I don't want to. But other than that, I'm just holding.
And also there's a good volume, trading volume every day. So it's quite very liquid stock, and options are liquid too. So I really, with stocks like this, Nvidia, and a couple of others, sometimes you think, why do we need any other stocks? Why to diversify when you're looking at straight winners, right?
Yeah, I love Nvidia. I'm waiting to see. You gave me one of the best investments I've ever done too, where I sold Nvidia options once at 600 before the split. Then it went. Then I did 800. Then now I have 200. I sold puts at 200 for 2023, and now stock is around 226, somewhere in there. So it was a fabulous play. But the only thing I'm waiting for, first of all, I think, maybe just take all the profits and wait till it's over 200 in another year. But the other thing is, I'm waiting to see if the ARM deal goes through or not, because maybe it'll drop 10%, 15% on the ARM deal. But in the long run, I just read that they're doing, whether or not the ARM deal is, they're doing more things like developing even better chips. I can't quite describe what I read because I'm not a tech expert.
Yeah.
But it's amazing what they're doing in their own company. They're like jumping ahead. Some people think, oh, Intel, is doing things to catch up and everything. But these people are not standing still, and they're so far ahead in terms of graphic chips. And
not going to be easy to touch for Intel. Or even AMD is another pretty good stock to invest, but I think Nvidia is much better than.
They're the check. There was a survey that said whose chips you prefer, basically, and like a survey of quality of chips, something like that, and they were number one, and ARM, the company that bought, was in the top 5 or 10 too, and those were the two companies that dominated. So again, I don't know. Intel may do fine, the other chip makers may be fine, but you know what? I'll go with Nvidia now and KLAC, because back to KLAC. Guess what? They all need the equipment, and they probably can't get enough, because I know Intel is expanding to do some new plants because they're trying to catch up, and they may or may not, but they're going to need equipment for that. And all the demand, every company, like I said, I'll buy the Levi's company any day, because I don't know who's going to find the gold, but I do know they all need to wear dungarees, right? Jeans.
That's right.
So I like the concept of KLAC.
Excellent. Peter, on this note, we'll end up today's program, and good luck in your trading, and we'll
You
see
too.
you next week on Wednesday at the same time. Okay. Thank you so much.
Bye
And
bye.
that was IBM Finance Show. My name is Sasha Star. Peter, bye bye.
Bye bye.
Bye bye, everybody.